Well, my next guest says the latest tariff developments haven't changed his market playbook into year end. He sees tech and growth continuing to lead the S&P higher, with opportunities broadening out as rate cuts approach. Joining me now is Scott Chronert, U.S. equity strategist at Citi. Scott, I'd love for you to just walk through what you think the market is reacting to here. At first blush, I thought, oh my gosh, stocks are going to soar because now we don't have potentially the handcuffs of tariffs. If now this is another court ruling saying, not so fast, Mr. Trump, you can't just put those in. But the opposite is happening. Stocks are down, yields are up. Can you just walk me through why you think that is?
Well, one guy's view, Courtney, but the way we're thinking about it is that, the market's been navigating and dealing with tariff-related uncertainty, well, since the beginning of this year. And as we move past the April lows, Liberation Day, and then Moratorium Day, and then all of the negotiations since then, the market, in our view, has gotten increasingly comfortable that fundamentals can survive even with a tariff backdrop. Now, we'd argued a while back that the tariff drag on S&P 500 earnings could be as much as 5%. That's been mitigated more recently by some of the tax reform measures with the recent budget negotiations. Now, here's the issue. If you thought you were getting closer to being able to navigate where tariffs are taking company fundamentals, and now you throw in this twist that maybe you have to rescind some of the tariffs, well, on the one hand, that's potentially an incremental positive for earnings. On the other hand, though, the market has also gotten comfortable that tariff-related revenues can be an offset to some of the deficit numbers. So you got a catch-22 here in terms of what part of this narrative do you want to focus on?
I mean, I understand all that, I suppose, but then when we just heard from a number of companies that reported that may or may not have had a tariff impact, many of them were able to mitigate much more of it than perhaps the market feared. That being said, because of all the deadlines and delays, not all of the impact was felt in the quarter just reported. Do you think that we're sounding relief a little bit too early?
We're seeing a few things, different things happen. You're seeing companies that have put out fairly, let's call it aggressive expectations for what they'd have to pay in tariffs, actually pull back on how much they think they'll have to pay, okay? As time's passed and we've gotten further away from, again, those April proposals. Now, on the other hand, you've got companies that, were saying, hey, we don't think there's going to be that much of an impact, that are now citing maybe there's a bit more of an impact in some of their fundamentals. And then you got this third cohort where, particularly among some of the retailers that are reported, that, our expectation was that they wouldn't be able to pass much through in terms of tariff costs to end prices, not enough consumer strength out there. So they'd have to eat it on gross margin. But you are hearing some anecdotes that these companies are now finding they can push some through. So what's happening here is that the tariff implementation is going down a fairly distinct company by company path. Makes it very difficult to look at it in aggregate and make a conclusion. But the bottom line here is I think we're going to continue to be navigating this ongoing drama for a while longer, for sure.
And before we sort of get to some of your picks, I love the point that you just made there about some retailers in particular being able to push on some of these cost increases in the form of prices, maybe more than they had previously thought. So if it turns out that these tariffs are no longer allowed to be implemented in the way that they are today, if you're a company, do you roll it back for consumers? And if you do that, then does that spur even more spending and then lead to more inflation because consumers are willing to spend anyways and now they can buy more?
That's a tricky one. I'm not quite sure how you would navigate that.
Sure.
I would expect that most companies or retailers in particular would roll back what they had envisioned putting in place. But this has all been a fluid situation anyway. And so it's unquestioned. I guess a big question as to whether you're actually rolling back or just resetting your expectations going forward. In any event, what it's doing is sort of reinvigorating the uncertainty that comes with this tariff discussion at a time when the market's had a good run, is trading at 25 times trailing earnings. And so you're going to be very sensitive to incremental news flow that is disrupting some of this this positive sentiment that's been so important to the market move over the past month.